three stocks, 52-week lows: Verizon, Tesla, Alibaba. Alibaba was down at one point today, almost 19% last time I saw. Tesla's down at one point to 204, 52-week low. And Verizon, I don't even look at Verizon anymore. We looked at Verizon last year. The thing I didn't like about it was the debt. So let's check it out now and see if anything's changed. Right, Mo?
Yes. BABA's down now 14.67%.
It's back, baby.
It is coming back.
All right, so Verizon's down 3.5% today. 52-week high, $55.51, $35.10 is the low, and it's currently at $35.80. Okay, so some point today, probably today, it was there. Dividend yield in the last 12 months was 7.1%. This is unsustainable. I don't understand this.
Wow.
$10.63 billion in dividends paid. Free cash flow last year was 10.1. Last 5 years, free cash flow was 7.53. That's my first alarming case. Huh.
Yeah. I mean,
Wow.
It looks like they had a boom in free cash flow in 2019.
Is that what it was?
I mean, it went from $12 billion to $16.5 billion to 21 to negative free cash flow in 2021. And that's not sustainable. Bottom line, that's not sustainable.
Okay. So let's look at the 8 pillars here.
But we are seeing that in this space with AT&T. They're paying a dividend that is not necessarily sustainable.
And another thing in this sector, really high debt. Guys, look at this. One of the things that I talk about a lot is debt. And with companies, debt works the exact same way as it does for you as an individual. The more debt a company has, when times get tough, it's going to be harder to pay that. Look at this debt. 31 times their 5-year average free cash flow. We want that number under 5 for our 8-pillar process. All right. So if you're new to the channel, we want to look at manageable debt. And the number I start with is 5 times the average free cash flow over the last 5 years. This is 31 times. This is 6 times higher than what we like. Okay. Very low return on invested capital.
Yeah, very low.
Revenue growth, big drop in net income and a drop in free cash flow. Now, the ratios are pretty solid. Now, one thing I don't like, the 5-year PE is much lower than the 5-year price of free cash flow. Now, guys, a lot of people would sit there and say, do more digging. I'm looking at this and I'm out. Why? These things just all don't make sense to me, and this is the clincher. And then a dividend yield that isn't supported by free cash flow. Why even look further? There's so many other options.
Of course. And if we want to even start getting into digging a little bit deeper, I mean, they just reported their earnings. People are moving away from their cell phone plans, it seems. AT&T gained like 300,000 plus postpaid subscribers. They've lost.
Have they?
They were losing, yeah. They lost. They net gained, but overall, they had a massive amount of outflux.
So keep in mind what I just said. I said, are they? I had no idea.
Yeah.
This is all I need to look at for me to go further. Because I look at it saying, even if all the news is rosy here, am I still okay with this? I don't think so. Analyst estimate. Let's just go to analyst estimates and see.
And pull up the balance sheet and just show real quick.
Oh my God, look at this growth. No, wait a second. Look at this growth. This year, I do $5.34 of earnings. In December of 2026, $5.55.
Stays the same.
That's not even, that's literally like, what is that growth? 1% or 2%? Yeah, it's 4% over 5 years, so less than 1% a year. Revenue growth, non-existent. So I'm looking at going,
why bother?
Why bother?
So you don't understand something,
okay,
and you're trying to force it. That's basically what you would be doing right now.
If I wanted to buy the company,
that would be the point of digging deeper.
Yeah.
And to me,
there's
I would
10,000.
say to you, if you were going to do it, there's 10,000 companies. Go find another one.
All right. Stock number 2, Tesla. All right, guys, Tesla's a doozy. So Tesla's down today 3%, $6.43 to 208. It was as low as 204 today. The 52-week low shows 198. All right, that's pretty low, guys. Considering the high is 415, that's pretty tough. So the stock is down over about 50% as of this very second. Now, I have stocks that are down a lot. Mm-hmm. Absolutely. But there's a difference between a stock being down because it's massively overpriced and unjustifiable with more losses to come, like Tesla, in my opinion, versus a company that's selling cheaper and I can buy more shares. Tesla's a very hard situation. Why? Look at their price to sales ratio, 9.6. The average car company is 0.5 to 1. The next comment out there is, Paul, it's not a car company. Okay, when the revenue is made up of more things that are not part of cars, I will agree with you.
Also, Elon Musk did say, we are a car company.
But he doesn't know what he's talking about.
That's true. On to the next.
So, I don't know what to say, guys, besides a car company that makes $9.5 billion, any company that makes $9.5 billion, even if it's going to grow 20% a year, how do you justify this market cap today to still have meat on the bone, right? So let's go to analyst estimates. Let's go to 8 pillars first. Sorry. All right. Well, low return on invested capital, high PE, high price to free cash flow, dilution, and debt.
Well, let's talk about the dilution. They're going to get rid of that pretty soon.
Oh my God. And he's buying back shares, which is literally the worst idea in the world. When a company buys back its own expensive shares, that's no different than buying an overpriced company outside. People just think, oh, they're buying back their shares. That's great. It's a manipulation. That's all it is. It's a terrible idea. When I saw it the other day, I literally went like this. The sign of the times. So let's go to analyst estimates. I mean, look at this. They're supposed to triple their profit according to analysts in the next 5 years. Revenue is going to triple as well.
Yep.
That's all great news. So let's do a 5-year analysis, assuming those exact same things.
Okay.
Stock analyzer tool. I'm going to change it from 10 to 5-year analysis. I'm just going to do what the analysts are saying. Tripling revenue in 5 years is 3 to the point 2, 24%, 25% growth. So I'm going to go 20, 25, and 30. Profit margin, I'm going to keep with 14. I'm going to go with 12, 14, and 16. Free cash flow, the same thing. PE. Now, guys, let's go 25, 30, and 35. That is obscene. The larger and larger a company gets, the lower the PE should be. If you think Tesla is still a small company, what are you smoking? It's a $700 billion market cap, $650 billion market cap. It does $85 billion in revenue or something crazy. How is that a small company? All right. Desired annual return, 12, 13, 15.
It is a small company.
14.
It is a small company when they're going to have a market cap the size of Apple and Saudi Aramco combined.
Yes.
So
that is a true statement based on what they just said.
That's from Elon Musk.
So I did 12, 14, and 16% on my desired returns. Why? Because you have to have margin of safety. And if you can invest in a long-term ETF for 9 or 10% return, in order to buy an individual stock with margin of safety, you got to pick a higher number. And the higher your assumptions, the less likely it would occur, the more margin of safety I want. I hit the analyze button. All right, guys. If you believe analyst estimates, you have to pay 147 based on my assumptions above. If you believe the assumptions are better than analyst estimates, 215, it's a buy today. So for those of you at 415 saying it was obvious, that's awkward. And if you believe low assumptions of 20% growth and 14% margin, it still has to drop in half. Guys, it's just math.
So I put in my own assumptions here, just one column, and I did realistic numbers more than, I don't think that even your low side, I don't think they're very realistic. I did 15% revenue growth, 13% profit margin, 20 PE, 15% return, and I'm getting $63.
Okay. By the way, what's my watch list?
$50.
It's on my watch list of $60.
There you go.
This doesn't mean I'm buying it at 60. It means go do more research, make sure you like it, and sell puts on it if you want. So if you want to sell puts on it.
Okay, go ahead. Mine's at 175 for the purpose of going maybe 6 to 8 months out and selling puts somewhere around this $63 range.
Oh, I don't think you can even do that. I don't think it's worth the squeeze.
I think the volatility might.
All right.
We'll see.
So let's say you like the stock at the 150 price or whatever it was that I said. Okay. What was the price in the middle? 150. If you want to go out to January of 2023 and sell a 150 put, actually, it's not bad. $6. So what this means, guys, is somebody will pay you $6 to give them the option of forcing you to buy the stock at 150. If you like it at 150, they're going to pay you $6 for 150. It's a 4% return. $6 divided by 150, and you only have to wait 90 days for that. So it's essentially like making 16% of your money. And you get the stock at 150 if it falls anywhere below 150. You still keep the $6, but now you get the stock at 150. Now, here's where everybody goes wrong. You only do this if you absolutely want the stock at 150, no matter what the market's at. If it falls to 100, your comment should be, that's okay. I wanted it at 150. I was going to buy it at 150 anyhow, so I'm okay with that. That's a very difficult thing to do emotionally.
Yeah, because the stock price gets to 100 and you say I'm already $50 underwater.
Correct.
$45.
When the actuality is you would have bought it at 150 no matter what. So if it was November 20th, hit 150, you were buying anyhow.
You would have gone and executed your own market order.
So this is a great way to make some money while waiting. Now for me, I'm not doing it at 150. No chance. Stock number 3. Alibaba.
Alibaba.
This bad boy is down big today. We're going to do some, Mo, why don't you show them on the charts what you were saying, what you said a while back about Alibaba?
So current price on Alibaba is $62. And I have been saying for a very long time, this is going to get to $58. I didn't say this could get to 58. I said this will get to 58. Why? Because the market's overpriced. And as the market comes down, none of these stocks are hidden from any of this volatility. This right here is your $58 level. This is the lowest it's ever been. They IPO'd back here. Lowest is like $58, maybe 57 and change. And it is now today right at that price. So
58.02 was the low today.
there you go. And $58 was that
And
number.
I remember when Mo told me $58, I was like,
And this was a long time ago.
it was a long time ago.
But I said, it's going to happen. It's going to
Now,
happen.
I'm not going to sit there when he says it's going to happen, take it as gold.
Yeah.
Because he once guessed the day of like a month of a stock market
And I
crash. And I
nailed
was
it.
like, okay.
And I nailed it.
Yeah, but
Because
Mo doesn't nail anything
I'm
else.
as good as Madoff.
So the point is, though, this is where we use charts. I like the fact he's like, Paul, this is a support level right here. I'm just looking at the support level saying, and it falls below that support level, watch out. Mo joked today and said it's going to zero.
Yeah, the next support level 0.
So we don't know what's going to happen, but that's how we look at this company. So 8 pillars. So apart from increasing shares outstanding and a temporary decrease in net income, it's all check marks here. Okay. Very low debt. This is a big factor I love about the company. Now, why is it down so much today? All Chinese companies are down today because the prime minister, whoever it is, Xi, got his 3rd term and he kicked out a few old guys who were all about economic growth, supposedly, and brought in some young guys who are more about ideology. Guys, I get that. And it is scary. But the fears that people have that I'm hearing about for China are the fears that they would have had 2, 3, 4, 5, 6, 7 years ago. It's just now that the stock is down, they perpetuate the story they perpetuate the stock going down with the story. Does that mean it's going to go up from here? No. It means that if this is an opportunity in the short run to buy shares, if you believe in the story and believe in Alibaba, I look at the income statement and I sit there and say, okay, is there still growth? There is still growth. Then I look at the analysts. I'm not looking at their buy ratings or sell ratings. Their analysts' expectations of revenue. $866 billion in their currency to 1.3 in the next 5-6 years. Earnings per share, 80% increase. Okay, I look at this going, does that sound, if I were to buy this company in full and the stock would be taken away, it'd only be a private enterprise, and this happened, would I make good money?
And remember, this is just one stock. If you're given 100 stocks like this in this situation, would you buy all 100 of them?
That's the big key.
This is not just about one single stock to your portfolio.
Correct. We want to sit there. We're part of a process. Just like Bryce Harper, who just made the world, he doesn't hit a home run. He doesn't get on base every single time he goes to bat. But if he gets on there 300 or 400 basis points every single time, he'll end up in the Hall of Fame. And that's what he does. And that's the key. So let's go to Alibaba. Let's do our stock analyzer tool here and then look at the puts. So analyst estimates for revenue growth are high single digits, low double digits. So I'm going to put in 4, 7, and 10. Profit margin, way lower this year. I'm going to go 13, 16, and 19. Nope, I'm sorry. 13, 18, and 23. Free cash flow, I'm going to do the exact same thing. PE, and guys, I do this different every single time, but the point is it still shows me a certain response. PE, guys, the PE is 30. I'm going to go even lower than that. I'm going to go 13, 15, 17, because it's still part of the largest growing middle class in the world and the fastest growing economy in size. China's economy grew 3.9% last quarter, which is slow. If we reported 3.9% in the US, the stock market would probably go to $1 billion.
And I can see a lot of people saying, well, what about the COVID zero policy and this and that? Guys, this is all just short-term stuff. Imagine how much stuff is going to happen over the next decade between China, the United States, Taiwan. Imagine where that's going to go.
Yeah.
It's not about that.
Now, my desired return of 12, 14, 16. Guys, I want to make note. This isn't like Tesla where I put in unreasonable high. It's not unreasonable to see 10% growth out of a company that's presence is in a country that's growing the fastest. This is not unreasonable. Hit the analyze button. The stock is currently at $62 a share. 75, 175, 120. Okay, let's go look at the puts.
Yeah. I mean, I'm looking at the $50 puts here.
For January?
I'm looking at November.
Okay, let's go to November 18th.
Yeah, November 18th.
$50 put gives you $1.25. That is 12.5% return for not even 1 month, 26 days.
Yep.
That's an annualized 30-some% return.
Yep.
It's pretty good money, guys.
Pretty good.
So if you want the stock at 50 and you really want the stock at 50 to wait 26 days, you're going to be paid. Yeah, that's incredible. That's a lot of money. And that's what happens with puts. When there's big drops, you can sell puts, and that volatility is going to really help you. When there's big jumps, you can sell calls because they feel like it's going to be more likely to happen. That's the big key for this.
Exactly.
Guys, I need you to do one thing here. This is especially important. You need to watch this next video about buying stocks at cheaper prices. Thank you very much for your time. There are over 10,000 stocks out there that you can choose from. If you've listened to our channel before, I talk about how you only need 30 or 40 really good ones. That's 0.3 or 0.4% of them to be good that will get outside returns. So the next question is, Paul, how do I find them?